All right, joining us now from Lagos, Nigeria is the CEO of Fidelity Bank, Reginald Ihejiahi. The company came out with unaudited results in today's session, showing 3.3 billion naira profit after tax from 980 million naira in the first half of 2009. A very good afternoon to you, Reginald. Let's start off with the fact that we have seen a very different picture from the first half of 2009 to the first half of 2010. Tell us what is driving profits at this point in time.
Well, I think, first of all, the results for last year, the same time for 2009, was affected by the provisioning that all banks in the industry had to take, which was a cleansing, and I think it was a good thing. This year, we have not had the same situation. So we're trying to also build our business and redirect it. And I think that's what you're seeing.
Well, you're saying provisioning, very different picture at this point in time. I'd just like to focus on your non-performing loans at this point, because we've seen an increase from the first half of last year to the first half of this year, and also total non-performing loans to total loans sitting at 25% in the first half of 2010 and 16% in the first half of 2009. Could you please give us some insight into that?
No, actually, I think the position is different because last year was the year we actually took a bath in the industry, and you ended up with a non-performing loan stock of close to 50 billion naira. If you look at what's going on, and the collections are not yet coming in into the accounts, and the accounts to June also have not reflected the new prudential guidelines that the central bank has actually released. Because you're not supposed to take that into account. So we're very happy with the level of collections. Collections so far are a little under 10 billion, and that's very, very good running for us at this point in time.
What growth rates do you anticipate, Reginald, for your loan book over the short to medium term?
Well, I'll give you an example. Total loan sanctions or approvals so far from January to June is roughly about 80 billion. Of that 80 billion in terms of new loans, these are not renewals, it's roughly about half of that. So there's a strong running already happening. And some of that, Lina, is actually loans coming from new sectors, as we have tried to put out. Last time I was here, I told you about what we're doing, Aisha, about what we're doing in terms of the manufacturing sector. That continues to do very well. But these loans are approvals. We think you have to give some time before they actually become drawdowns, given the way the structure works here in Nigeria.
Reginald, taking a look at the deposits, which are lower this year compared to the same time last year, tell us about your deposit mix at this point in time and how it's sort of spread out between the corporates and the retail deposits.
Well, the bulk of our deposits are actually retail. Well over 63% of them are retail. We went through a period where we actually had to move away from the more expensive end of the market to the less expensive end of the market. And we got to a situation where our weighted average cost of funds, as we speak at the end of June, was a little over 4.5%, compared to close to double that last year. So we had to give up the more expensive loans and then build up the less expensive loans. It's also been helped by the branch network. We've been very aggressive in opening new branches. This was part of our strategy running over 2 years. And these branches are coming in now. So while the deposit base may not have grown the way you think, in terms of actually quality and stability, we're very happy because we're having cheaper loans and we're also having a broader sense of contribution to the deposit base.
Just looking at the retail side of things, because here in South Africa we know that retail banking is still under pressure, corporate looking far better. How do you see that playing out in Nigeria going forward?
I think what's going to happen in Nigeria is that the market would be doing a rediscovery of new sectors, and very important. That's what we're also doing here in Fidelity. The sectors actually that represent the real economy, but it requires some engagement to get in there. We are looking at manufacturing in particular. We're beginning to see manufacturing centers, manufacturing companies set up their own independent power plants, small projects, or looking at them actually moving from diesel and the national grid to gas. So that gives them clear stability in their operations, and we're interested in beginning to fund that. I think in this market too, people tend to forget that the number of bank accounts, even at the retail side, is not where it should be. So there's a lot of headroom for growth in the Nigerian market, a lot of headroom, both in the retail end, both in the corporate, but the nature of the corporate will be different from what we have seen in the past. We are expecting that a lot of the corporates or the upper end of the corporates will begin to approach the bond market themselves. And as they do that, the banks will now have to be able to fill the gap in a more creative way. And I think that's something we're looking forward to doing. And I told you the kind of levels of new credit approvals we've done, which will begin to come into activity as we approach the third and fourth quarter of the year.
Reginald, speaking of creativity, we know that Fidelity Bank was one of the first banks to show some kind of interest in buying a rescued bank and all those troubled banks as well. Tell us about what your long-term strategy with regards to this, and if you think that this is still something that the bank is going to be considering down the line.
Our strategy is simple with regard to this. We need more distribution. We need more contact points with our customers. That's what we're looking at. We're also looking at more opportunities to be able to campaign at the corporate end of the market in a new way. The institutions we're interested in are institutions that have the retail network that, while added to our own retail network, we think will give us a market presence that we are seeking. This is all in line with our long-term strategy, which is clearly to be a strong commercial bank with a strong corporate and investment bank end to it.
The central bank has also been relatively vocal about having specialized banks in Nigeria, which will probably replace the current universal banking model. What is your view on this? What role is Fidelity Bank going to play?
Well, speaking only for Fidelity, like I said, we will continue to be a commercial bank, strong commercial bank, supported by service, supported by technology. We'll also continue to have onto that a strong corporate bank because that's important for the future. So we would not be seeking to become a specialized bank in any form.
Taking a look at the Ancon Bull, which was signed last month, obviously quite important in terms of the impact it's going to have on the banking sector. What is your view on this? We know that many banks are going to be contributing to fund Ancon.
Well, we think that it's important in a self-help sense for the industry to participate in its own salvation. I think that we all are very anxious that the market returns to some level of normalcy, so we can begin to actually pursue the growth sides of the economy as we see it, the real economy. We think that Ancon will help us get that done, or help the regulator get that done. So we're supportive of Ancon itself. We're also supportive of the necessity for the banks in the industry to make a contribution, and not just to rely on the fiscal resources of the society to get that done. We're anxious for Ancon to start operations as quickly as possible. We have assurances that that will happen very, very quickly indeed. Normalcy is actually best for everybody in this economy, especially for the banks.
Reginald, very quickly, in the last half of 2009, you declared a dividend of 2.5 kobo. Of course, these are unaudited results that we're looking at here. Any plans to increase the dividends and to resume the dividend going forward?
Well, let me make this point. We've paid dividends year on year, every year for the past 7 years. The way we approach things in the bank is that we agree a dividend policy, and we work this through over 3 years. We expect to be able to continue to pay dividends this year. And in no time, at no time, even in the worst situations in our industry, did Fidelity not pay dividends. So our shareholders are very, very happy about this. We just came out of our annual general meeting last week, and they were really pleased that, in spite of all odds, that we continue to explain the company to them, explain our strategy to them, and continue also to reward shareholders. The kind of shareholders we have, or buyers of our stock, are people actually who will continue to look at the long term.
Reginald, thank you so very much for your time this afternoon.